Late on Friday afternoon, rating agency Moody's downgraded the U.S. government's debt, sending shockwaves through the financial media anyway. The way this is being framed is some big blow to the bond market, if not Uncle Sam himself, when neither of those are really true, and that's what's really troubling about all this. To begin with, we all know the government is broke. It is, in fact, the brokest thing ever created in all of human existence. And that's neither hyperbole, nor is it even close. Nothing else compares where it comes to borrowings. But naturally and understandably, people have been warning about this for the last 2 decades, in particular going back to George W. Bush and his TARP scheme. It seems like this should be a big deal, yet the problem only ever gets worse and nothing ever happens about it. There is no response to the indebtedness, or there doesn't seem to be one. Most people overlook this because it doesn't fit with how they think this should work. After all, if you and I took out an insane amount of loans, there would come a time very quickly when every last lender, even the risk takers, would say enough is enough, go away. See, the fact this doesn't happen to Uncle Sam is the whole thing, and that's the part you need to understand and focus on. The implications are enormous and has absolutely nothing to do with some government printing press like everyone says. To begin with, there is no printing press, at least not one the federal government has or can use. This is all about depression economics, and we need to explain what that is. You need to ask yourself, how can the brokest thing in human existence only ever get even broker? And the answer is because something else even more important got broke. As I said, this is all about depression economics, and the fact that the government can continue to borrow as much as it does is an acknowledgement of exactly that. But first of all, what Moody's did late Friday after everything was closed, at least according to Bloomberg, the U.S. government lost its last AAA credit score from a major international ratings firm after a downgrade by Moody's Investors Service on May 16, in a bleak milestone for the world's largest economy. That's the thing, it's not a milestone. It sounds like it should be, but it's really not. Explaining the move, Moody's analysts cited more than a decade of inaction by successive U.S. administrations and Congress to arrest a trend of large fiscal deficits. The government's debt interest costs ballooned when inflation spiked in the aftermath of COVID-19 because it wasn't inflation, and are forecast to reach $1 trillion this year, up from $263 billion in 2017, at least according to Congress's Government Accountability Office. And the market has already shrugged this news off. Well, initially, in the aftermath of the announcement, again, late Friday afternoon, interest rates, the 10-year bond, the 30-year bond, which many people are focusing on, they went up. And in fact, this morning, the 10-year yield got as high as 456, even 457. But already in the afternoon, it has reversed. So the 10-year was 453 on Thursday. That fell a little bit to 445 on Friday. Like I said, it shot up around 457 today. But it's already back to 448 this afternoon. And the reason why is, as we've talked about here in this channel, the extreme indications that we always point to that relate to interest rates and forward interest rates, they haven't changed one bit. While they're off some of their more urgent highs or lows, depending on what we're talking about, from last month, they aren't really all that much, as we'll go over a little bit later in this video. What those point to is the depression economics, which holds demand for safety and liquidity above everything else. Not to mention the fact that we've seen these ratings downgrades before, 2 of them. In fact, the question to ask with Moody's is what the hell took them so long? We all know, as I said, the government's broke and it's not getting any better. What matters is why. These ratings downgrades don't matter. The fact that nothing changed after the previous downgrades really suggests everything we're talking about here. Fitch downgraded U.S. government debt in August of 2023. And what Fitch said was basically the same thing as Moody's. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades. That's the common theme, last 2 decades, that is manifested in repeated debt limit standoffs and last-minute resolutions. In Fitch's view, there's been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June 2023 bipartisan agreement to suspend the debt limit until January 2025, which has come back into effect. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. And all of this was foreseen by S&P, who downgraded the U.S. government's debt way the hell back in August of 2011. And what S&P said in 2011 is exactly what Fitch and now Moody said many, many years later. We have lowered our long-term sovereign credit rating on the United States of America to AA plus from AAA and affirmed the A1 plus short-term rating. We lowered our long-term rating on the U.S. because we believe that the prolonged controversy over raising the statutory debt ceiling and the related fiscal policy debate indicate that further near-term progress or long-term progress containing the growth in public spending, especially on entitlements, or on reaching an agreement on raising revenues is less likely than we previously assumed and will remain a contentious and fitful process, which is exactly what has happened. We also believe that the fiscal consolidation plan that Congress and the administration agreed to this week, back in 2011, falls short of the amount that we believe is necessary to stabilize the general government debt burden by the middle of the decade. And of course, none of that actually happened, nor did any of this actually matter. At the time when S&P downgraded the debt in 2011, people thought it was, this seemed like a big shock. But yet, in the middle of that shock, when that shock was taking place in 2011, we had a monetary banking crisis that was erupting around the world. So while so many people in the financial media were talking about the status of the government's debt, everybody was buying that debt and then some because of the Depression economics. It was becoming more and more apparent at that time. And they never, despite the Fed's claims, they never went away over the decade plus since then. In fact, you can see this in interest rates, especially when you compare interest rates to the Fed's manipulation of the short end. Back on August 1st of 2023, when Fitch issued its downgrade of the U.S. government debt, the U.S. Treasury 10-year was at 4.05% and heading higher. In fact, it got to be almost 5% by October of that year, back when everybody was thinking, okay, this Fitch downgrade actually means something. The federal government has gone too far this time. Interest rates are about to skyrocket and soar, but they never actually did. And that's the question you need to answer. Why didn't interest rates soar in 2023 more than any time over the last 20 years? Because it seemed like everything was going in the wrong direction for the bond market. You had the Fitch downgrade, the prior S&P one on top of that. You also had inflation expectations, at least according to the financial media and the mainstream narrative. You had a Fed that seemed like it was going to aggressively raise rates and hold rates higher for longer. You had the federal government that was, per the Fitch downgrade, that was completely going insane, issuing an unbelievable amount of debt at that moment in time. And yet, interest rates, like I said, the 10-year got up to around 5%, very close to 5%, and it's been basically sideways to lower ever since then. And just for reference, the 10-year back in August of 2011 was at 258 the day the S&P announcement came out. In the 30-year bond, which is one that a lot of people are talking about because it's the highest rate in the curve, so of course they want to use that as their representation, back on August 1st of 2023 with a Fitch downgrade, the 30-year was at 4.11%, and it would go above 5% in October of 2023, reaching a high of around 5.09%. So back in August of 2011, the 30-year was at 3.82%. But you have to compare where yields are now with short-term rates, because the Fed has manipulated the front end of the yield curve for no good purposes, where they were back in, say, 2011. What I mean is, back on August 1st of 2023, the short-term interest rate of the federal funds range, the upper bound was 5.5%, which meant that the 10-year Treasury yield was 145 basis points beneath the Federal Reserve's upper bound for the range. So an inverted yield curve to the federal funds rate of 145 basis points. Back on August 5th of 2011, even though the nominal yield on the Treasury was lower than it was in 2023, it was at the time 233 basis points above the upper bound of the federal funds range. So the yield curve was much steeper back in 2011 than it was in 2023, which means that the debt downgrades, along with all the debt that was issued in between, made absolutely no difference. In fact, currently, as of this morning, with the 10-year Treasury at 4.48, 4.49, it's a couple basis points below the 4.5% upper bound for the federal funds range right now. So over the dozen to 14 years since the initial downgrade from S&P back in 2011, Treasury yields have gotten lower relative to the federal funds front end and the Federal Reserve's interference in the yield curve, despite the fact of almost $30 trillion in debt that was issued between then and now. It was $30 trillion since the end of 2008. but a massive amount of debt and everything else that's happened in between. So the question you have to ask is, how in the world can this possibly be? How can the federal government get this broke and this insane and keep doing it year after year, and Treasury yields get lower and lower and lower relative to the front end of the curve? The downgrades have collectively made no difference. The amount of debt has made no difference. And it's perfectly understandable why people believe this should and why they even want this to be true. Because the government is out of control. And you get no argument from me on that. Because of its financing abilities, it has been able to expand into more and more of everything. The more money it borrows, the bigger it gets, the more it erodes economic freedom. When the government has more money that it can use, that money comes with strings attached. So you want Uncle Sam's cash, now you've got to do what Uncle Sam wants. And we're getting an example of that right now, how this goes both ways. But it's not just economic liberties. The bigger the government's borrowing in treasuries, the more that it can do to stifle everything in everyday life. The bigger Uncle Sam becomes, the more the Leviathan it ends up being, the worse it is for everybody. So the idea is that if the treasury market blows up, that will put a stop to all this madness. People have been hoping for this to happen for 2 decades now, but it hasn't. But rather than ask why it hasn't happened, a lot of them simply move their expectations further out in time. They say it hasn't happened yet. Okay, we get that. But it will happen and you'll see. But it hasn't happened yet and it won't. And I'm here to tell you why. And I don't relish delivering this message. I'm not happy about this any more than you are. The simple truth is politicians have figured out the depression economics and what it means for them. There is a seemingly bottomless appetite for government debt. There are no bond vigilantes. So to get control of the government's finances will necessarily mean voting differently and demanding fiscal responsibility be a top priority. No, Doge is nowhere near enough. That can be at most classified as a decent yet even questionable start. What matters for interest rates, however, the only thing that matters is this depression economics. And we've got them all over the place. The supply shock in consumer prices did not change them in the least. What that means is the demand for perceived safety and liquidity. Yes, even after what was the second basis trade blow-up last month, treasuries are still king on the depression economics mountain. Full stop. We can hate the fact that they are. It doesn't change that they're treated this way. So what are depression economics? Well, a good example is to go back to the 1930s, back when we had an inarguable Great Depression. And what did interest rates do in the Great Depression? They went down. Some interest rates on those instruments that were perceived to be safe in liquidity, including the treasury market and treasury bonds. This despite the fact that, just like now, the government had radically changed its borrowing patterns. Before then, government was expected to run balanced budgets and be fiscally responsible outside of war periods. Instead, with the rise of the New Deal, the Treasury market, the Treasury Department went crazy issuing debt. And a lot of people at the time said the same things that you hear nowadays, that the government had gone too far and there wouldn't be enough lending to support all of this government financing. But as the Depression wore on, there was seemingly a bottomless pit of demand for those safe and liquid instruments. Another example of this, Japan, especially in the 1990s and 2000s, it's lost decades. In the 2010s, same thing. What happened was, again, the economy fell off into a depression, and it was an inarguable depression. And the bond market told you that because of the overarching demand for safety and liquidity. Interest rates fell throughout the 1990s, not because of the Bank of Japan or any monetary or interest rate policies, but because of the fundamentals of depression economics. Heightened demand for safety, heightened demand for liquidity, low growth and inflation expectations, to which the Japanese economy only lived up to. So as the Japanese government debt exploded higher, it never had a problem financing it. It had unlimited borrowing capacity so long as depression economics remained in full force, which they do to this day. It's not the Bank of Japan. It's not some printing press. It is the depression. So as the government gets broker and broker and broker, it doesn't matter where this is, it's because the economy and the monetary system are broke even more. So just think about it over the last couple of years. Everyone said coming out of the pandemic and the federal government went crazy in 2020 and again in 2021, First of all, they said without the Fed and its QE, interest rates were going to skyrocket. They didn't. Rates were not all that high. They never really got to be all that high, at least not considered in historical context. And the only reason they went up at all, as I said before, was the Fed panicking over the supply shock and forcing up the short-term interest rate, to which interest rates actually rebelled against, which is why we got these deep levels of inversions. The market fought against the rate hikes from the Fed. It fought against the Treasury debt issuance. It fought against inflation narratives. It even fought against the Fed's QT, which was a comprehensive demonstration of these depression economics. Everything that every mainstream critic has said that should lead to the destruction of the Treasury market ended up happening, except for the destruction of the Treasury market. That didn't. In terms of QT, everybody said without the Fed's QE, the Treasury market was toast. Instead, since June of 2022, the Federal Reserve has run off $1.56 trillion in just U.S. Treasuries. And ever since June of 2022, rates have been sideways, despite the fact the Fed continued to hike its short-term rates along the way. Even with issuance exploding, even the Fed continuing to hold up short-term interest rates, and even, well, despite everyone's narrative about inflation that wasn't actually true, the fact that the Treasury market continues to do what it does is everything that you should be focused on. Not these credit downgrades, nor the level of government debt. That's its own separate problem. The bond market is not going to fix this fiscal insanity for us. What really matters to the bond market are fundamentals. Now, you'd think it'd be supply and demand, and it is, but just not in the way that the mainstream always says. What they say is that it's about Treasury supply coming from the government or some other kind of public demand, as in from the Federal Reserve and quantitative easing, the bond buying that the Fed does. So what you're led to believe is that only the public side matters. Either the Treasury issuing more debt, therefore rates must go up, or the Fed buying less debt, therefore rates must also go up. But in both situations, if the Fed is buying less or the Treasury is selling more, private demand steps up. And if the fundamentals argue for depression economics, private demand will fill the need regardless. For example, a bank or another non-bank or some other financial firm has a choice to lend it to someone at, say, 6%, or they could buy a Treasury at 4%. If the economy is good, that 6% on a risk-adjusted basis would look perfectly fine. Therefore, there's less private market participants who would want Treasuries. Treasury yields would go up in that situation, which is consistent with reflationary conditions. But if you have the same 6% economic opportunity, and if the economy is crappy, then the risk-adjusted return isn't worth taking the additional risk. So more people would buy Treasuries no matter what the federal government or the Federal Reserve is doing. And the more people who agree, the more Treasuries they buy. So the less the Fed buys, the more the private economy comes in to fill in the demand. It is supply and demand. It's just that they're always missing anything outside the public realm. What they tell you is it's always about the government in one way or the other, when it's really about the private side and the fundamentals the private economy uses to decide whether or not they want to demand safety and liquidity. And so we see this all over the marketplace, these extreme signals that have only gotten more and more extreme. What they're saying is that, for example, interest rate swap spreads have become deeply negative. There are very likely to be more people who will be looking at the risk opportunities the second way as I laid out. It's not worth lending to any riskier borrowers. Therefore, more demand for Treasuries. Therefore, rates are going to go down, including those from central banks, which is what interest rate swap spreads are talking about. And that's exactly what we've seen over the last couple of years, really going back to 2023. When the Fitch downgrade came out in August of 2023, swap spreads started to compress even more, which meant going even further into the negative. And what that meant was the market, even though everyone said that the Treasury market had gone too far, the Treasury government had gone too far, swap market was saying, no, there's going to be more demand for Treasuries, not less, because the fundamental environment, according to the swap market and a whole bunch more that's connected to it, kept saying the economic fundamentals were getting weaker and weaker and weaker, and therefore, over time, more demand for safety, liquidity, lower growth and inflation expectations, which is what we're really starting to see emerge from all of this economic fog. Same thing with the copper to gold ratios and others that are suggesting more deflationary conditions than anything else. And deflationary conditions would mean heightened demand for safety and liquidity, lower growth and inflation expectations, therefore private demand for Treasuries over and above whatever it is the public side might be doing, either the Fed or the federal government. And as you can see, these extreme indications have not really gotten all that less extreme over the month and a half or so since the liquidations that were forced upon the world by deflationary conditions earlier in April. So there is a coherent, internally consistent structure and reasoning and everything that goes into why Fitch didn't matter, S&P didn't matter, Uncle Sam doesn't matter. So the Moody's downgrade doesn't even move the needle. In fact, we're left asking what took them so long to do this. Everybody with eyes can see that the federal government is broke as it is. But that's the point. The federal government is broke, and it's getting more and more broke as it goes along. The fact that this doesn't matter is what really matters. The fact that the broke government can get even broker means the economy itself is the most broke in all of this. Depression economics. And we just got more evidence and another reminder of this from outside the US in Japan. Japan, more recession there. Talked about the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.